and therefore most traders lose, not because they don't know what they are doing, but because they have not mastered liquidity, or they are just hearing the word and the word sounds nice to them. So liquidation, that's why we even call it liquidation, that you've been stopped out with generally a loss. So what the institutions do, they push the market towards where we have the buy side liquidity, and they close all the orders there. With them, they can know that the market is having, there are so much of orders at this particular point, or so much of the orders at this particular point. They come, they hunt. Usually we call it the liquidity sweep hunt. So by this, they hunt you and they close your order. But then, and in the video today, we're going to be looking at liquidity in the Forex trading market. Liquidity is a common term in the Forex trading market, and this is especially in the smart money concepts. So today I want to simplify liquidity to a point that by the time you leave this particular video, you've mastered liquidity, you know the importance of liquidity, you know what liquidity is, you know the types of liquidity and how to trade with liquidity. However, if you haven't subscribed onto our YouTube channel, please do, such that you enjoy the content, the information we happen to share. You can also come onto our different platforms still, again to do with Forex, and you also benefit from the videos, from the content we happen to share on these platforms. That is after confirming you're on the right platforms. First things first, before I happen to waste any single second, when it comes to liquidity, in English, I would generally say liquidity is basically how easy it is to buy or sell something quickly without changing its price too much. So the ease with which you can buy or sell something without changing its price too much generally means what liquidity in English. However, when it comes to Forex trading, it's a bit different. So generally in English, we have, say, I can give an example of cash. Cash is highly liquid, and you can use it immediately. Whereas land is more of an investment, and its liquidity is quite low. It takes time to sell it. So I believe for now you understand what liquidity is in the perspective of English. When it comes to Forex, liquidity now happens to change in meaning. Generally, in Forex, by definition, liquidity means where money, I can say orders, are sitting in the Forex trading market. In simple terms, liquidity can be area where many traders have placed orders, the buy orders and the sell orders. And in these areas, we happen to see the stop losses are there, the pending orders are there, and the big institutions want to trade there. This is what it means by liquidity. So we're going to see how do you identify these areas in the market. Practically, I'm also going to share with you the screen of how you can tell what liquidity is, and a lot more that has to do with liquidity. That's why I've decided to make this video simpler and easier for us to understand. But then, before you go any further, it's also key, it's important that we happen to know the types of liquidity before we further go deep into it, because it's also important, it helps us know the kind of liquidity that we are trying, or that we try to identify on our platforms. So we have two types of liquidity. We have what we consider as the SSL and the BSL. That is the buy side liquidity and the sell side liquidity. When we talk of the BSL, such as buy side liquidity, this liquidity, it happens above generally the market. And this can easily be found above the equal highs, that is where there is the resistance, or slightly above the resistance. And why it happens to exist there, it's because traders put stop losses above highs, and the market has to go there to collect them, to hunt them. So retailers generally trade minus them knowing there is someone hunting them, which are the institutions, which are the smart money. So that's where we generally have liquidity, and I'm going to show you practically on the chart using TradingView to see how we can identify buy-side liquidity. Sell-side liquidity is generally the opposite, and it's normally abbreviated as SSL, sell-side liquidity. And then this generally liquidity is normally below the market, and we can say it's normally below the equal lows in the market, where there is normally the support levels. And it happens to be there because traders put stop losses there, below there, and the market has to go there to grab it. Or the smart money has to go there to grab it. So when we come into the market, I'm going to give you an example specifically definitely when we reach along the chart here. So this is today's chart, and it is probably GBP dollar, right? GBP US dollar. I've just made a screenshot right now to clearly make this easier for you to understand. So we said that liquidity normally happens along below this particular level. So we said above here is where we experience the BSL, that is the buy side liquidity, and below down here is where we happen to experience the sell side liquidity. Now, usually the best way to trade liquidity when we are trading is looking for equal highs or equal lows. Like an example is this: I have this equal high. Then this significantly can show to us that along this particular point we have the buy side liquidity along this particular point. So this is what usually happens. The institutions will always come first, but then instead of immediately reversing along this particular point, let me get my pen first, and maybe I can explain to you better. So the institutions will actually move the market towards where there is liquidity, because in the first place we have said that liquidity lies along these particular levels, right? And also this is the buy side liquidity, then this is the sell side liquidity. So market always flows where there is liquidity, from one point of liquidity to another point of liquidity. So this is how the smart money trades. Usually the institutional traders don't pay attention to this, and they just anyhow trade. But what institutions will do, will hunt them and will always look for where you're placing orders, and definitely move the market to that particular point or to that direction. So you as an institutional, you as a retail trader, what you have to do is to identify where there is liquidity and also trade appropriately. So what they do, they have a tendency of moving the market like this, and they slightly push and they slightly come to pull all their orders, because they know people that are selling here. They have placed their stops along this particular point. So what they do, they come and they close these trades with losses and eventually come down. So the existence of this week that was along this particular point showed presence of smart money. Just as here, it showed, just as you can see here, this also showed that the smart money came and liquidated you because of the existence of these weeks. It showed presence of a smart money, and therefore most traders lose, not because they don't know what they are doing, but because they have not mastered liquidity, or they are just hearing the word and the word sounds nice to them. So liquidation, that's why we even call it liquidation, that you've been stopped out with generally a loss. So what the institutions do, they push the market towards where we have the buy side liquidity, and they close all the orders there. With them, they can know that the market is having, there are so much of orders at this particular point, or so much of the orders at this particular point. They come, they hunt. Usually we call it the liquidity sweep hunt. So by this, they hunt you and they close your order, but then eventually push the market to the direction. That's why most newbies say, the market closed me and now eventually came to my direction. Or probably there is someone seeing in the market that is monitoring. The same thing happened. We also see a week here which showed that there was liquidation along this particular point. Stop loss orders are closed here and the market eventually goes up. So you realize that along this equal highs, equal lows, we are experiencing liquidations or liquidity along that particular point. So a person who is supposed to trade the right way should wait for the market to go and show existence of, smart money, or the sharp tails we have seen, and then as it comes back, then this is when you are supposed to enter, for instance, with a sell here. So this now should be the right point after the existence of this for you to start selling, because it has already liquidated so many of people here, hence entering the market. So generally, that's how we can identify liquidity. And those of you that thought of liquidity of something different, something complicated, that is generally liquidity. So the importance of liquidity, knowing the liquidity, it helps you know where prices are likely to go, to avoid fake moves. Once you know, this is why I actually told you in the beginning that first wait for the liquidation and then come in to sell or to buy, respectively. Understanding market manipulation. So it's generally there is manipulation along that particular point. So if you've mastered liquidity, then you can probably get to know that there is manipulation here. Then you wait for the manipulation, then you can immediately go in and also trade like institution traders. So another approach may be what we can use to identify liquidity, because liquidity can be entered differently. So the one I illustrated first was liquidity sweep, or sometimes what we consider as the stop hunt. And then probably the other approach is what we consider as the break and retest after liquidity grab. So this is another approach that we can also generally use, but I'll just elaborate something for you here. So let me get my pen. So after a formation set of like this, of course the bank, the smart money, the institutions know that you're placing so much of your sell orders along this particular point, and each sell order usually has a stop loss. I can illustrate as SL, and then this is SL. So it knows, the smart money knows that you're placing your orders here. So what it does, it comes, closes you with the loss, but instead it doesn't come back down. It just retests, and then we who know smart money and happen to know that this is now not a break, this is not rather maybe a consolidation, but rather a break. So usually it has a tendency, it closes out, it retests, and then eventually can now exceed to upwards, down. The same can happen downwards here. So for us, what we do, we wait for the market to close, and then once it closes here along this particular point, we get any signs that now it's making a pullback, then we can ideally look forward buying and go with the move upwards, or with the trend upwards. So it's also another approach. I believe I've tried to explain it, elaborate it clearly, but of course it's with the interest of time that I don't waste a lot. However, with the interest of time, I'm going to stop from here. In any case, you have any challenges, don't hesitate to contact us. We'll always be in position to help you regarding this. Have a lovely day. Enjoy. Thank you.